My name is Jim Weisel, Professor of Accountancy at Georgia Gwinnett College. In this video, we are going to introduce the accounting for leases. Lease accounting is one of the more complex issues that we come across in the advanced accounting classes. And that's because there are so many options, and leases themselves can be fairly complex agreements. U.S. GAAP is currently guided by Accounting Standards Codification Topic number 840, although there is an exposure draft that exists. It was issued in May of 2013, which is proposed to revise Topic number 840, and that is Topic number 842. In one of the later videos, we'll talk about the current environment of accounting for leases and some of the potential changes that are coming. IFRS standards are very similar, although there are some differences between US GAAP and IFRS. But IFRS standards is guided primarily by International Accounting Standards, IAS number 17. Alright, so this is an introduction to leases, and we need to start with the very basics, and that is, what is a lease, and why do companies or individuals lease assets rather than buying them? So a lease is a contractual agreement between a lessor who owns the asset and the lessee who is going to borrow and make use of that asset. It gives the lessee the right to use the asset for a specific period of time. And in return for being able to use an asset, the lessee is going to make rental payments over the lease term. So it's basically nothing more than borrowing some property and agreeing to make some payments over time. So leases can be for a variety of types of assets. They can be for real property, such as buildings and land, or they can be for other types of assets: automobiles, trucks, equipment, computer, information systems, and so on. Now, there are a number of reasons why a business or a lessee may choose to lease assets rather than buying them, and that's kind of what I want to focus on in the discussion here. So one of the advantages of leasing versus buying is 100% financing, or nearly 100% financing. Generally speaking, when we buy an asset, even if we are borrowing money to acquire that asset, there is going to be a significant amount of cash outflow that's going to be needed initially. With leasing arrangements, very often the owner of the asset, the lessor, is willing to let us use the asset with very little or possibly even no cash down. Now we see those kinds of ads on TV all the time, right? The sign and drive auto leasing arrangements where you have very little cash that needs to be put up front, and then you can have a car for a while. So one of the advantages of leasing is typically, or very often, there is a significant lesser amount of cash that's needed up front in order to begin making use of an asset. So from a business perspective, if I'm interested in conserving cash, or maybe I don't have much cash but still need to expand my business, then leasing is a possible option. One of the other reasons for leasing is protection against obsolescence. Remember that if we are borrowing an asset, it's still owned by somebody else. And so at the end of the lease term, we just simply turn that asset back to the owner and we're done. And so if we are in need of, for example, staying in front of technology, for whatever reason our business requires the latest and greatest in terms of technology, then leasing those technology resources might be a viable option, because we can lease them for 1 year, 2 years, 3 years, And then when we're done, since we don't own them, we can turn them back in and start another lease on the next new round of technology. So for that reason, leasing offers a potential protection against obsolescence. Third possible reason or advantage for leasing is flexibility. A lot of times we have the ability to cease or to stop a lease early, even though we may have originally said, well, we're going to rent this asset for 24 months, for 2 years, but there may be a clause in there whereby we can get out of that lease early if we need to. And so that gives us some flexibility. If we had purchased the asset outright and we want to move on to something else, since it's our asset, we have to sell it. And so that significantly reduces our flexibility. Think about, for example, owning a home rather than renting an apartment. So if you have a job and you own your own home and that employer says, we're going to relocate you to California, then you need to be able to sell your home and then move out to California. Well, if you're just simply renting the house or renting an apartment, you might be able to simply just give 30 days notice and say, I'm gone. And so there's less risk there in terms of having a leased asset or a rental asset rather than an owned asset. So it just gives us some additional flexibility. Another advantage of leasing is less costly financing. Things have kind of tightened up in the current economic environment. There is less difference between the cost of leasing and the cost of borrowing money to finance a purchase. But nevertheless, leasing can very often lead to less costly financing. There is always, remember, when we're borrowing assets or borrowing cash, there's going to be a cost of financing. The question is how much and when do we recognize that and how do we go about recognizing that cost of financing. So it's not free financing, but leasing can very often lead to less costly financing than alternative means of acquiring assets. Next advantage, potentially, of leasing is tax advantages. Now again, this very much depends on the structure of the lease versus the structure of the purchase of the asset, but there can sometimes be some tax advantages. And we'll talk in more detail about what those tax advantages might be when we get into the recognition and balance sheet and income statement disclosures, how are expenses recognized for certain kinds of leases versus the cash flow that's associated with those leases. And for that reason, there may be some tax advantages. And then finally, and this is where the proposed standards are going to make a significant impact. But right now, under the current rules for U.S. GAAP, we have the possibility of what's known as off-balance sheet financing. Some lease agreements begin or are treated as simply a short-term rental, and where the cash payments simply are recorded as a lease expense or a rental expense. And even though we may be using that asset for a long time, it never makes its way to the balance sheet. The asset is never capitalized on the balance sheet. And so we have very often some circumstances where we're making use of assets that are not recognized on the balance sheet. Leasing, for example, is very popular in the airline industry. A lot of airlines simply do not own all of their aircraft. They lease them. Depending on how the lease agreement is structured, they may have numerous aircraft that they're using in their flight operations that are never recorded as an asset on the balance sheet, and the obligation, the liability associated with the lease payments is never recognized as a liability on the liability side of the balance sheet. So there are some possibilities of making use of assets in what's known as off-balance sheet financing. And that, as I mentioned just a minute ago, is where ASC topic number 842 is going to address some things. And the proposed standards basically are going to eliminate or significantly reduce the possibility of off-balance sheet financing. In any case, those are the primary advantages of leasing types of arrangements rather than purchasing an asset. So that's our quick introduction to leases. What are leases, and why would we go about leasing assets or rather than purchasing them?